Hello, everyone. Andy will be joining us in just a minute, and we'll get started. Thank you so much for your time here. I'm going to queue up the presentation, so give me 1 minute. As we're waiting for Andy, we can go through some quick housekeeping stuff. You might have questions throughout this presentation. We love them. Please send them in. You're welcome to drop them here in the chat. Or use the Q&A function. Or if you want to email them over, you can email them to me, Robin, ROBYN at strategyleaders.com, and I will pop that in the chat here as well. So yeah, I hope you enjoyed today's webinar, and Andy will be here again in just 1 minute, and we will get started. Thank you for your time.
Hey there, Robin.
Hello, we're ready to get started when you are.
Okay, great. Welcome everybody to today's webinar, Monetizing Your Business and Figuring Out Smart Smart Exit Strategies that go beyond private equity, which is something that I think a lot of business owners are hearing about and cold calls that they're getting. So we'll talk a little bit about PE, and then we're going to go way beyond that in terms of options. And why don't we just you want to give everybody a couple minutes to join, or I can do a little bit of advertising while we're here. So let me introduce you to myself, Andi Gray, and the company Strategy Leaders. We started this company based on research that was done at Columbia University. As a company, we've been around for 30 years and have a skilled team of people who are specialists at working with the owners of privately held businesses, dealing with their challenges and their opportunities. We have experience in a ton of different industries: wholesale, retail, manufacturing, service businesses, you name it, we've probably worked in it. And we do have a nationwide footprint. We work east to west, north to south, so geography is not a problem for us. And we do offer a broad set of services, which I'll talk about in just a second. In the meantime, let me just draw your attention to the QR code down at the bottom right of the page. You can use that to get right to my calendar and get information on a booking link and set up a meeting to talk with me about where you are and what's going on. It's a free consultation, and I encourage you to come and explore the possibilities. I love talking to business owners. So with that, let's talk a little bit more about some of the stuff we work on. Let's go to the next slide. Ways that we do help our business owners as clients is with establishing valuations for their businesses, preparing key performance indicators, doing forecasting and what-if modeling. We do a lot of work in terms of building growth programs and business plans for our clients, and working on transition planning and implementation. So how do you get ready, and then how do you get through it? In terms of the ways that we work on that, we work on management team development, provide executive coaching. We have a broad set of buy and sell advisory services and a whole book of next generation training and development programming. So again, use the QR code to set up a free consultation and come and explore the possibilities for your business. So let's get on with today's webinar. Robin, are we good to go?
Yep, we're good.
Okay, great. So in terms of successfully monetizing your business, this is all about creating business value that then turns into wealth your way. I want to break this down into success, which is the accomplishment of an aim or a purpose, and then monetization, which is all about getting your money out. And what I have learned over the years is that most business owners do have goals. They know that they have to exit someday, but they don't have a workable plan to get them there. And that's what we want to help you fix. So let's start working on fixing that today by giving you insight into various ways to get. So you do have options. Monetization does not necessarily mean full sale of the business. It can be partial, it can be phased, and it can also be internal. You can get liquidity and stay engaged in the business, or you can get out if you don't want to be there. It does start however you want to go about it. It does start with a valuation, a factual understanding of what the business is worth, and then work on a plan to get what you want in order to achieve the monetization that you need and want. The key concept on this page is that liquidity doesn't always mean loss of control. There are ways to stay engaged depending on how much liquidity and over what period of time. So Key question, what about private equity? I get asked this all the time. And I think it's because so many business owners out there are getting questions or getting calls from private equity boiler rooms. And I will tell you that what is being offered or suggested often becomes very different from what the reality is at the end of the engagement. It can be right for the right businesses, but they need to be scalable, have clean books, a strong team, a business owner who is willing to let go and who is okay with their employees being fired and much of what they've built being dismantled. You've got to be okay with that. But it's not for everyone. If you do consider it, you're going to deal with pressure, uncertain financial outcomes because guaranteed the payout will be over time, not upfront. And when it comes to the company, to be very difficult to deal with. But there are other smart ways to get paid, and that's what we're going to look at today. So in terms of paths to monetization, we're going to talk about 6 of them today. These are probably the most common paths to monetization, and then there are tons of permutations on them. So we'll start with these 6. First is an internal buyout where you're selling to management or family. Second, an ESOP, an employee stock ownership plan, partial sale to a strategic financial or internal buyer, a dividend recapitalization or share buyback, an asset sale with earnout, and then initiating a roll-up or in a merger for future liquidity is also an interesting way to go. So go big or go home. Let's go take a look at each one of these options. Internal buyout, management or family, is where you're going to sell the business to key employees or to family members. It's ideal when there is a strong internal talent or family member interest, and it is typically financed over time through installments or through loans. There is often less cash up front, but not necessarily. And that depends on the availability of the bank to play with you and the willingness for the bank to capitalize the deal. It does offer you flexibility and continuity if you're going to go down this route. You can have a gradual transition, which you can negotiate how you stay involved and over what period of time, as long as you do that up front before you cut the deal. But this is probably the easiest place to negotiate terms. It does take trust, preparation, and leadership development, and it is, in my opinion, the most overlooked option because owners think the buyers can't afford it. And in truth, the buyers don't really have to have any assets. The funding of the deal comes from the strength of the business. And if the owner doesn't want to finance the whole deal, that's okay. The owners can partially finance and get bank financing to back them up. Typically, the bank will finance up to about 80% of the deal and ask the owner to hold 20% as the down payment for a year or maybe 2 years. And then after that, they can cash that out. ESOPs are another way to go. This is where you sell shares into a trust and the employees become owners through that trust. And as a result, the employees essentially gain a retirement program. It is best done with profitable companies and long tenured, committed, well-organized staff. It offers partial or full liquidity and it has significant tax benefits. So one of the things you have to think about with most exit plans, you're going to pay tax on the profits that you're gaining from the sale. Often that eats up 30–40% or more when you consider federal, state, and local taxes. And in an ESOP, you may actually get away with this with little or no taxes. So if you think about 40% of the deal going to taxes or going into your pocket, there is a significant motivator right there for thinking about going this route. The owners can get to stay on board either as employees or at the board level, and they can negotiate their involvement. The owners can stay in control as the employees become owners as well, and they do this through their board control most often. And you need specialists to set it up and help oversee it. That's why you need the profitable company to be able to afford this. The bank then finances the transaction, and the company again takes on the transaction and paying the debt off on the transaction. It does preserve company legacy, and it will reward employee contribution by keeping the company intact, so the shares are going to stay inside the company. And it is something I would encourage you to think about, and if you don't know enough about it, come and talk to us and we can start getting you an education. Okay, next one. So you can also look at a partial sale to a strategic financial or internal buyer. This is where you're going to sell a minority or majority stake to an outside investor. It's good fit if you want liquidity now, but you do see significant growth potential, both revenue and profits in the future, and you want to hang on to some of that upside potential. And then it can lead to a second larger exit down the road as the company grows and you're able to sell your remaining shares. Deal structure is critical. You have to pay attention to valuations, governance, reporting and finance and extra terms, and make sure that you understand those clearly. Don't gloss over them, because this is where you either will have someone else eating your lunch or you'll eat your lunch. It requires strong alignment between the owner and the investor. You need to be able to work together post-deal. And it does allow for shared decision making, but it will also require a potential shift in direction. The hint here, my recommendation is to look for family offices and industry partners. So by industry partners, I mean someone who you work with already and they're looking to do either forward or backward integration. They're looking to pick up a supplier or they're looking to pick up a distribution route. And family office is looking for consistent, steady returns with limited risk. And what you're going to offer them is a steady return and growth opportunity. Okay, next comes dividend recapitalization or share buyback. And this is where you're going to extract value without selling out by issuing yourself a dividend. So you sell a portion, or you can actually sell a portion of shares back to the company. If you're going to go that route, just make sure you stay over 50%. This is funded through business debt and future cash flow. It works best for profitable businesses that have stable performance. It increases financial risk due to new debt obligations, but it does allow you to maintain control. And you have to just make sure that your company can support the debt and remain resilient even as it's paying off that debt. So we had a company recently that had a senior member of the team who needed to get out, and they needed to monetize their shares, and they actually were able to sell the shares back to the company, and at the same time the remaining owners were able to maintain control because they still as a group maintained over 50% of the share control. So there's lots of ways to get this done. Just pay attention to the amount of debt. Asset sale with an earnout. You can sell part or all of the business. This is a straight sale based on the assets only. The future payouts are tied to performance, and it fits when the buyer wants to reduce risk and the seller believes in the upside. So I want to get some of my cash out now, and I'll wait for some of it later. There is a lower upfront payment usually made in these deals, and the remainder is paid based on future results. So it gets to be a bit more closer to what you see in private equity terms. Profit and earnout terms have to be clearly defined and measurable. And in most cases, the seller is required to stay on for some variation on period of time, both to make sure that the transition is working well, that there's good growth, and that the employees follow the owner's lead. But the success does depend on growth, profit, and accurate reporting. Then the other way to go is this is kind of the go big or go home role. So you can initiate a roll up or engage in a merger for future liquidity. If you're going to do a roll up, you'd acquire and join together companies in a fractured market. So, for example, this has happened recently in the HVAC industry where a group of companies have been bought up and merged into a larger company, and they all got out, and the acquirer then has a bigger company to run and can afford the financing that went with all the acquisitions because they have a larger company that is more efficient and more profitable. The other way to go is to merge with other companies that are like-minded in order to create scale and efficiency. So taking 2 or 3 service companies or manufacturing companies and bringing them all together. Either one of these strategies can be effective in fragmented industries that will benefit from consolidation. Often these deals are equity-based, so the financing is based on the value of shares in the future with limited cash upfront, and the potential for a larger future exit through sale or an IPO. But it does involve shared control, and you have to be prepared to work to integrate the operations. It is a longer term strategy, and it requires alignment and operational discipline, as well as clarity about who owns what and who's going to be responsible for what. So how other owners are monetizing without selling out. Here are some examples of companies that we've worked with and have some experience with. The owner selling to a leadership team. They've created long-term engagement and cash flow. We've seen this a lot in service industries where they've got a team of management and some of the executives want to get out, and other people coming up in the organization want to grow onto the leadership team, and they've actually then sold the shares into and out of the participants that are on the leadership team. The owner is used to a dividend recap to take money off the table. This again, this is not my most favorite way to go, because if you're not actually able to get the rewards that you want through regular distributions, you got to really make sure that the business can sustain the payment on the debts that it will take in order to give you the cash flow you need now. But this can be a way to go in an emergency situation. So the owner needs to get some cash out of the business quickly. The owner then implements a roll-up. We've done this a lot, putting together or going and doing an acquisition to bring other companies that are similar together in order to take out inefficiencies and build up the value of the business by having a larger company, and then ultimately preparing to sell or actually converting that into an ESOP or selling it to the employees without an ESOP. And then the other one is joining forces via merger. We've also seen a client do this. They really did not think that they could get their money off the table just by a straight sale, but by joining forces with a larger company that was in the industry that really wanted their knowledge, their expertise, and their client list, they were able to become part of a larger company, gain shares in that larger company, and then ultimately monetize those shares at a much higher level than what they were able to monetize at if they just sold the business. The thing I will say to all of you, though, is success takes work over time. None of this happens by accident. So let's do a little bit of recap here, and then we're going to take your questions. So in terms of recap, aligning exit with succession, 2 key components. Monetization, that's the financial engine. If you don't know how to monetize it, come and talk to us. We know how to do that, and we've got the contacts that are trustworthy, reasonable in terms of expectations and time to work on things and the cost of working on things. And succession is the leadership continuity. You need that if you're going to actually build anything other than a straight asset sale exit right now. And a good successor will protect your payout. That's why it's worth working on it. And if you don't know how to build that, again, come and talk to us. This is what we do all day long. But keep in mind that succession and monetization support each other as you work your way through whatever transaction you think is going to make the most sense for you. But what you need is a good payout plan and a great people plan, and you've got to put those together. We're going to talk briefly about what drives value and then what kills value, and then we're going to go take your questions. So what buyers and investors actually want is consistent profitability and growth, independence of the business from the owner, so that it is not owner reliant, clean financial reporting, and an owner who has realistic expectations. By that, I mean the owner knows what the business is worth, and is negotiating on that, not on what they need. There are other ways to get done what you need, but you've got to have realistic expectations on the sale value of the business. You also need process and systems that are mature. You need to work through those, well documented, working efficiently, taking out issues and obstacles, and basically quality controlling the business. And then you want a well-structured, disciplined, accountable team that's laid out in a very clear organizational chart with strong second-tier leadership able to step in. And then a low client concentration is also extremely valuable. If you're talking to a bank will say that they value most concentrations under 8% with any one client, and buyers are generally looking for the same as our investors. So what destroys business value, kills deals, drags down your price? You're still the bottleneck. You're the owner and the business relies on you. You got to get out of that mindset. I know it is something that is hard to do because it is rewarding to the ego to have people ask you for your opinion, ask you for your help, but it is also something that buyers in the future do not want. They are looking for companies that have a second tier. If there is no second tier, or if the org chart is not clear who reports to whom, how people grow within the organization, it is going to make your buyers nervous. Sloppy books, that's going to cost you a lot of money when it comes to due diligence. Weak systems and limited process documentation is something that the buyer is going to then discount whatever process you decide to go through. If your revenue is tied to a few clients or few projects, that means a lot of risk to the buyer. And if there's inconsistent performance, so we're dealing with this right now with a client of ours that is looking to do an internal transaction, and what they're finding is that the value has actually dropped from 2 years ago because sales dropped 2 years ago. They've actually recovered this year, but not enough to make up for and pay off all the debts that were incurred last year. And because of that, the business is not worth nearly what it was 2 years ago. Now, will it recover after another year? Maybe. Do the buyers want to wait? No. They want to get this deal done. So just keep in mind that buyers will look under the hood and they will find the truth, no matter how sophisticated or unsophisticated the buyer may be. The buyer is going to get advisors, and the advisors are going to help them understand what they're looking at. You've got to be prepared for that. So your monetization action plan, here's a bunch of things you can use as a checklist. First of all, clarify who are your optimal buyer targets. Decide how involved you want to stay. Talk to a valuation expert and get an idea of a clear understanding of what the business is worth and how that value can grow under different conditions. Identify the right exit models that you think are going to work the best for you. Strengthen your leadership team. This just makes sense no matter what you're doing, because as long as you own it, they can take the monkey off of your back. And once you sell it, that creates value that the buyer is going to want to acquire. Clean up your financials and your standard operating procedures, and then begin building optionality. Well, optionality, ways to go. I can pivot. If this works, I can do this. If this works, I can do that. And as the economy changes or shifts and black swans come at you, you have more than one option to get out. That's the smartest way to go. So next steps, let's figure out where you are and where you want to go. You see up at the top, right next to your next step, a QR code. Please take a picture of it, go click on it, and get to my calendar and set up a time for a free strategy session. There is no pressure, just get you some clarity about where you are and what you need to do. Keep in mind, as right where back to where we started this, most business owners have goals. They know they have to exit someday, but they don't have a workable plan, and that's what we want to help you fix. With that, there's lots of ways that we can help: brainstorming, figuring things out, assessing and bringing tools and people and systems to the table, working on training and coaching, preparing people for the company to survive, assisting with opportunities for growth and transition, building thriving companies, and creating wealth for our clients. That's what we're all about. We'd love to put that to work for you. And with that, drop your request and email in the chat window, shoot us an email, click on the QR code, book an intro call, and register for our next webinar, How to Grow Without Losing Control. This is going to be in September, on September 24th. It's all about growth doesn't necessarily have to mean chaos. It's about building a roadmap, delegation exercises, a framework for shifting from founder to team, and a clear next steps to map out and determine how to get the weeds out and get into leadership what you want. With that, Robin, I'm going to turn it over to you and we'll play Stump the Presenter. Let's see what we have for questions.
Yeah, we have a couple good questions.
All right, great.
The first one is actually from Dr. Perkins. Nice to see you, Betty. But the question is, do the principles you discussed apply to nonprofit businesses?
In most cases, yes. And the reason I put an in most cases caveat on that is that you need the board to be engaged and approve whatever direction you're going to go in. Probably doing a distribution to the owner is not going to be something that the board is going to approve or should approve, because that would take on aspects of self-dealing. There certainly was a very big case in New York City 10 years ago about a not-for-profit that chose that route and got into a lot of trouble for it. But other than that, and then the other question is, will the board approve an ESOP or not? And does it make sense to do that? Given that you're already a not-for-profit, do you need an ESOP in order to go in that direction? So what you have to think about is who's on the board, what are they up for, how do you, in terms of working with the board, how do you need to educate them as well as get yourself educated? And then in terms of control long-term, where do the voting rights sit?
Perfect, thank you. Okay, the next one I got was, I don't understand which might be the most advantageous for me. How do I figure that out?
Question, because there's lots of options. And I think this starts with building a set of your own key criteria. And by that, you want to look at, okay, what period of time, how much, so let's say it's in 3 years, how much flexibility is there around that time? So there's absolutely no flexibility. And there's a hard stop in 3 years versus I could waiver a year or two on either side. Then what assets do I have in place currently and how strong are those assets and what would have to happen to develop those assets? How well am I engaged with potential partners or people that are interested in my business, and what do I have to do in order to get them engaged? So I have one client that's looking at exit within the next couple of years, and he's spent a lot of time in the last several years building his connection with his peer group so that he knows the people to talk to when he's ready to pull the trigger. If you've got that, that's great. If you don't have that, the question is, do you have the time to spend on that or not? So there is no right answer here. There are a lot of questions to answer. I would suggest get on a call with us and we can talk you through the specifics of your situation.
Great. Speaking of time, the next question we have is how much time do I need to get ready?
Well, if you talk to most people who are working on exits, they'll say if you have a year or less, you just have to take what you can get. And you probably are going to pursue an asset sale or sell into merge into a larger company that is interested in you. But you got to get going with getting the transaction done because it'll take almost a year just to get the deal done. If you have more time than that, then if typically if you have about 3 years, you actually have more maneuvering room. So we had a client who was pretty clear 3 years from now I want to be out. And what we have done in the last 3 years is put a key player into a management training and development program and work with financing instruments so that the business is preparing to be monetized by the bank and the next generation is preparing to be able to successfully run the company. And the owner is then also preparing to stay on and get a salary and continue to participate for another couple of years post sale, but with less risk. So, as you can see, it kind of again comes down to what are some of your goals and what are you trying to accomplish and what time frame. If you've got 5 years or more, you can probably choose any direction to go and you've got a lot of options. The thing that I would caution you in either the 3 or the 5 year window is you've really got to separate yourself from working in the business to working on where you're trying to go with the future of the business. You can't do both and do them both well. And what happens is you keep getting sucked back into the business and distracted from the things that you need to be doing in order to prepare for that exit. This becomes your number one job, and you've got to be really selfish and really dedicated about it. I have a client we're working with right now, and he's just really caught between I want out and I'm essential to the business. And every time he starts building a little momentum on working on his exit strategy, he gets pulled back into a client negotiation, a client trip, an employee quality assurance plan, some hiring. And this is stuff that he actually has employees who can be doing much of this work, and he can do some additional hiring to round out his organization chart. But he loves being essential. And so he keeps getting sucked into being essential. And if he can't get out of that, he's going to give up enormous value when he goes to sell the business. And it's a wonderful business that should have a lot of value going into the future.
Great. I also think that I know that I've seen, when we're there to say, hey, what are you doing? Like, is this what you should be focused on? That our clients tend to remember, oh, yeah, I'm focusing towards this end goal versus kind of getting lost in the what's exciting.
Absolutely, Robin. That's a huge reminder. So you don't learn to play a new game by accident. It's like going to the gym, and you'll do better going to the gym by working with a trainer than you will going on your own. And what you've got to do is make sure that you've got a good trainer, a good coach who's going to work with you every week. This is what we're working on. Let's maintain focus. Let's build next steps list. Let's make sure that we've got a game plan that we can all stay on board with and that we can then bring other employees into that game as well so that they can play a bigger role.
Yeah, I think that probably being the ones I've seen most successful in terms of the owners not being sucked back into the day to day is when they are transparent with their team to say, hey, I'm not here to be in the day to day anymore. That's your job. Come to me with solutions, not problems.
And it gets a lot easier to actually do that and be completely transparent with employees. If you are going to look at the options of selling the company to the employees, I will tell you that besides ESOP, selling the company to the employees is probably going to be the most financially rewarding way to go because the employees have a vested interest. They want to maintain their jobs, they want to own the company, and the company, as long as it can fund the transaction, even if you have to do it in stages, you can stay and watch what's happening and make sure that you're getting the debts paid off so that the company does continue to be valuable in the future and your loans are not at risk. the employees are going to buy that company at a higher price than an outsider is, and certainly at a far higher price than a private equity firm is going to offer you, no matter what it looks like on paper.
Yep. We have one last question. This one actually came up in a call also that I had recently with a prospect, so it's kind of funny that it came up here. I have a great company. We're making money every year. Why would I want to give that up?
Yep, we deal with that all day long with our clients. And the question is, do you want to give it up? So we have a fairly significant company that the owners actually have moved and they continue to own the shares and profit while a management team is now in place doing the work and reporting to the board. And so now the owners have the best of both worlds. They have a management team doing the work. They have the profits that they always had coming from the increase in the growth and profitability of the business. And they don't have to work at the day-to-day jobs. They just have to work at the board jobs. I think that's a great way to go. And what they're essentially doing is they're slowly but surely creating their own family office by doing this. And I had a conference call with them this morning, or with the management team this morning. And in fact, what the board is now doing is starting to bring in the next generation to some of the meetings. So the board is also working on their succession plan in order to maintain the family office into another generation. And I think that's so cool. This company has actually been around for several generations and it's going to stay. And all the people that have worked so hard to get the company where it is today will get to keep their jobs.
Yeah, I think we had another client a couple years ago who is did a similar structure, but now she and her husband like live on cruise ships year round. So,
Yep.
there's lots of options out there. And that's it. That's all the questions we got.
So please come and talk to us. We would love to hear about your story. We will send out the presentation to everyone who attended. If you know anyone else who would like a copy of the presentation, please let us know and we'll get it to them as well. And then Robin will be working hard to take clips and post it out on social media. And make sure you register for the next webinar. You do see the QR code here for the next webinar, and we'd love to see you there.
Perfect. Thank you, everyone. Thank you, Andy.
Thank you guys. Thanks for coming today.
Bye.
Bye.